one of nine. All right. So my dad is one of nine, which means I have aunts and uncles and cousins for days. I am in Trinidad at the moment, and I am meeting cousins that I've never met. I've been alive for this long. I'm still meeting cousins that I've never met. Right. So in my house, you could imagine that any game is highly competitive. And there was one game in particular that we like to play, which should just be banned because this game never ends well. And it was Monopoly. So growing up, I knew how to play Monopoly, and Monopoly was like a full contact sport. The game ended when somebody was broke. All right, that was the rules. You are done playing when you have no more money and you can borrow no more money. So I'm grown up now, and I want to pass on this tradition, and I play Monopoly with my nephew. And he can't beat me. I don't think he's ever beaten me. And we're playing, and we're going at this, and by the end of it, he's mortgaged up to the eyeballs. I own just about every property. He's paying me rent. He owes me back rent. The game is done now. I can't get any more money from him. Now, my nephew was 6, okay? And before you say that I was bullying a 6-year-old, it's a game. Once we start playing the game, the rules apply. I don't have to teach him. I'm not his dad. I'm his uncle, all right? We playing, and I'm playing to win. His dad can let him win. That's fine. That's what my brother can do. Me, I'm looking to win this game. Now, it's a funny story, and hopefully it's this image that will stick in your head, because I think the majority of us engage in financial services like a 6-year-old playing Monopoly. We don't quite understand the rules, but we got the money. So you know what? I want that orange house. Let me see if I can collect all of these colors. We don't quite understand what it is we're doing. And when we don't, we will be at a disadvantage. Is this making sense? Yeah. Again, I know I'm speaking to only two cameras. I can't see the rest of you guys. So pop it in the chat. Yeah, makes sense. Just give me something. Let me know I've got a little bit of feedback. I'm not speaking to an empty room. I hope it's making sense. We're getting started. Good. Thank you, TJ. I see that. Now, as I mentioned, the company I'm with is Genistar. We're one of the fastest growing financial services company in the UK, and we are dedicated to educating families. We want to help people make better choices. And if there's any phrase that I use a lot and again and again and again, is that when you know better, you will do better. And that's the whole purpose of education, so that we can know better and then make better choices when those come up. Obviously, as a professional company, we are regulated by the FCA, just like every other financial services company in the United Kingdom. That's how that's the umbrella that we come under, authorized and regulated there. So as you will see on every page, it'll give you our FCA number if you wanted to look us up. There's my email, there's my phone number. There will be points throughout this presentation when it's going to give you the option to book in for a further meeting and to have a further conversation. It's going to be on the screen. Feel free to engage with that there. Now, I'm going to cover these concepts today. Some of them are going to be fast because I am looking at the time. I've been told I've got about an hour. I'm going to talk about how to become an owner, not a loaner, how to pay off debt fast. The fact that a mortgage is not a home, I swear, this is one of my pet peeves. You don't want a mortgage, you want a home. I will talk about that. I'm going to talk about taking control, paying yourself first, and about the concept of an additional income. So I'm going to cover a lot of ground. We've got 6 different points, and they're going to be in sections. I do hope that you all have like a notebook so you can take notes. Feel free to write it in the chat. I'm pretty sure Olatunu and Dolapo are going to help me keep an eye on the chat. So if there's a question that I come back to, because I may not answer the questions as we go through the flow, I might come to it at the end. Write it down in your notebook, write it down in a chat so that we can have a bit of dialogue and engagement, okay? Now, so first concept is become an owner, not a loaner. Here's the thing. The way we deal with our money, we loan our money. And I'll get to why I say that. A lot of people, when they thinking about saving and growing their money, the idea is that the bank account is safe. Investing is risky. And on a surface level, there is some truth to that. But I want to ask you, have you ever thought about the fact that you might be earning a guaranteed loss? Yeah. Here, what? Do me a favor. If you have savings, don't tell me how much, which means if you had anything above £1, in savings, just put a 1 in the chat, say yes, right? 1 is a yes. Anything. I don't even know. You don't have to tell me how much. So we're not comparing. You've got something in savings. Just put a 1. All right. Okay. So we're doing the right thing. You guys are already on the right track. But let me talk to you about, again, this is where the rules come into play. Okay. Let's say that you had a £10,000 and the bank was giving you 1% rate of return. Okay. Now, if you think that the average in the UK is anywhere between 0.1 and 1.3, 1% is on the high side of where the sort of the average savings account would lie. Now, 1% of 10,000 means that in the year, you're going to earn £100 in interest. Okay, so you guys still with me, right? You're going to pay 20% on that. Now, that's assuming that you're in the lower tax bracket. So you're going to pay 20% on that interest. So your net earnings in a year would have been 80. That would mean that at the end of the year, your resulting balance would be 10,080. It's only 1 year. Okay, repeat the same thing next year. So we have growth, although it's slow. However, what about inflation? Now, I know right now inflation is sitting at about 3%. Last year, it went up to about 11, nearly 12%. Now, let's hope it stays low again. But I don't know if you guys pay attention. The UK is historically low. When we hit like 10%, my friends from South Africa were like, now you see what we live with all the time. Friends from other part of the globe were like, yeah, that's normal. We had a really weird low period for ages. So now it's back down to 3, but I'm never going to guess as to what it's going to do. Last year, it hit 10%. Now, if it was 10%, your buying power from that last year would have actually dropped to 9,072. So what that means is that when you put your card in the cash machine, it's going to say 10,080. But you're going to be able to buy 9,072 pounds worth of goods. Now, I know we all understand inflation because we're adults, right? So we've all seen, I mean, one of my friends told me a story recently, and I laugh because I drive an electric car, so I have built-in smugness, right? We just feel somewhat superior to people who put petrol in their car. It's true. I am being a little bit funny about it, but I do like that I don't have to go put petrol in a car. But he was telling me about how he put the pump in the car and he clicked the button and he started daydreaming. He said, I don't know what I was thinking about, but I heard it click. And then there was a panic because when he looked at the number, it said he owed 90 pounds. And he said, I have never put 90 pounds in my car before. So he was thankful because he had the money to pay for it, because he was thinking, I hope there's 90 pounds that I could pay for this petrol. But petrol had never cost him 90 pounds before. And if you drive, you have seen that price go. Now, the quality of the petrol hasn't gotten better. It was just the cost. That is a little snapshot of what inflation does. It takes the same thing and it makes it more expensive, which means your same money goes less far. That makes sense. I'm pretty sure that I'm not telling you anything you didn't know. But can you see how in this scenario, your good intentions of saving that money has resulted in a guaranteed loss for your family? As a matter of fact, I go so far to say this is the safest way to lose money. Are there plenty of ways to lose money? This is your safest route. Just put it in the bank and let it erode. Now, the tragedy is it sometimes erodes faster than other times, because even this year at 3%, if it's growing at 1, but falling by 3, you literally are 1 step forward, 3 steps back. You are still losing money. You would need inflation to fall below 1% for your money to actually be growing. Is this making sense? So we're on the right track with savings, but can we turn it up a gear? Can we learn something to adjust this? I do believe we can. So I'm going to talk you through the rule of 72. Now, I'm not going to ask you to engage with me so much on this. We are going to get to it. I will tell you this. The rule of 72 was found because it's a mathematical rule. It's always existed. We just didn't realize. But it was discovered over 400 years ago. No, I want you to think about that. Some of you I have sat with, so you know this rule of 72 and you should remember it, but if you don't, that's okay. Today's a refresher. Those of you who have never come across somebody from Genistar, or to be honest, have you ever heard of the rule of 72? A 400-year-old principle that talks about how money operates over time, and most people have never heard of it. I've been doing this presentation for 15 years, and I have met 4 people who said, yes, I've heard of this. And it wasn't because they met somebody from Genistar. 4. I remember once, it was in 2012, the BBC ran an article in their summer magazine, The Rule of 72 and Why You Should Know About It. And I thought back in 2012, well, this is it. Everybody's going to know about the Rule of 72 moving forward because look, it's printed. I still haven't met a person who's heard of the Rule of 72 since then. I haven't. The 4 people I met was before 2012. It's like no less and less people know. Nobody knows about the Rule of 72. So let me explain why it's important. Okay. This rule tells you how long it takes your money to double. So remember, we just had the 10,000 at 1%. Let's pretend it's at 3. So let's say you have 10,000 at 3%. You get a special favored rate of return because you know that you're not just going to pick up 3% just like that. I mean, 3% that doesn't disappear. I know some bank accounts will say, we'll give you 3% for 12 months. So we give you 3% for 24 months. But after that, you're going back down to the base rate, right? How long would it take 10,000 to become 20,000 if it was going at 3%? Actually, you know what? I do want to engage. Just put in the chat. How many years do you think it would take the 10 to become 20? Anybody? 20 years. See, now, Dolapo, you're not paying that much attention because there's no 20 on the screen. So clearly, it can't be 20. It's a guide right here. I'm just checking to see who's checking it. Olotunu, you cheated. You shouldn't have answered because I know you know the answer. It's 24 years. So it'll take 24 years for 10 to become 20. It'll take a further 24 years, so up to 48 years to become 40. So I want you guys to think about this for a second. I don't know what the average house price is in Bicester, where you guys are at. I'm assuming the majority of you are in the Bicester, Oxford area. I don't know what the average house price is, but you still class as Southeast. And the Southeast, everything is more expensive. So I'm going to say that, oh, so 3, okay, so 40,000 would be like a decent 10% deposit. Is that right? Up thereabouts, you probably need a bit more than that. Okay, so how many of you are willing to wait half a century to get the money for a deposit? I swear, if you have kids right now, they're not willing to wait half a century because unless they're 0, that would mean that they are going to be in their 60s before they could get this first deposit for the house. This is ridiculous. This is not money that's growing for us. Okay, I'm not going to ask you how old you be. I know that I will be well beyond my pension age after 48 years. And can we all agree that 40,000 is not retirement money? You are not living on retirement with 40,000 in the United Kingdom. Can we agree on that? That sounds fair? Okay. So when we double from 3 to 6, most people think we should double from 40 to 80. But it doesn't work like that. See, because when we go from 3 to 6, the money now doubles every 12 years. So you're asking me, why is it that it doubles in 24? Why is it that it doubles in 12? Well, here's what the rule of 72 says. If you take the rate that you're offered, divide that into 72. So 72 divided by 6 is 12. 72 divided by 3 is 24. Now you have the doubling cycle. Now, feel free to write it down and look it up. We did not create the rule of 72. Like I said, it's been over 400 years, and I want to tell you it's an approximation. The actual number is not 72. It's like 69. 69, I think, gives you more accurate, but it's going to give you, it won't give you a whole number. It might say 23.75 or something like that. So it won't give you a whole number. So for ease of understanding, I'm going to use 72 because it rounds the years up. So we're talking about 12 years to double once. Now, if it doubles once in 12 years, by the time we get to 48 years, it would have doubled 4 times. Are you guys still following me? So now we have 160,000. And as Olotunu says, the average house price in Vista is 330,000. We can't pay off the mortgage yet. It's 50 years. We can't pay off the house yet. And can we agree that in today's Britain, that's not retirement money either? Unless you plan on living for like, I don't know, 3-4 years, that's not enough money. You're going to need more money than that. Is that fair to say as well? So let me go one more time. I'm going to go from 6 to 12. I want to show you guys what happens here, because at 12%, this money is going to double every 6 years. Because if 6 doubles every 12, 12 will double every 6, right? Number of times it goes into 72. That means by the time we get to 24 years, we have 160,000. So we're moving a lot faster now. So I'm going to pause here, and I want to go back to this question that I very clearly ignored. Do you know how banks make money? Anybody? You can pop it in the chat. How do banks make money? And I want you to remember my analogy of playing Monopoly against a 6-year-old. I will tell you in this story here, we're the 6-year-old. Unfortunate to say, we are the 6-year-old. And the bank knows the rules. Bukola says stocks, lending out, borrowing. Both, all of you were correct. Now, let me ask you a silly question. Do you think they lend it out at 3%? Or they lend it out at, yes, exactly, with our unused money. Now, remember the title of the section is Become an Owner, Not a Loaner, right? I'm coming back to that. Because the money that we give the bank, it's like we loan them the money. And then they use that money to make more money. Because when we put it in, let's say they gave you 3%, Olapo, which they're not going to do. They're going to give you less than that. But let's say they give you 3%. They're going to take your 10,000 and they're going to move it over here. Now, maybe they invest it here. But you guys do realize that the banks own the credit card companies, right? So your Aqua card is owned by, I think, Barclays. And all of these cards with the 35 and 45 and 48% I have seen, they're all owned by the banks. The same banks that we take and put our money in, they transfer it and they lend it out. They make a lot of money, and then they give you back the change. They don't give you back the profit from that money because that was them working your money. They give you back the change. So let me ask you guys, and put it in the chat, just a round number, or unmute yourself and share the number. What do you think? Olatunde, not you. How much money would the bank have made with your money by the end of 48 years? How much? What's the figure down here? All guesses are welcome, except from Olatunde. She's not allowed to guess. No calculators. Go on. Who's the brave soul? Who's going to come out? By the way, everybody gets this wrong, so it doesn't matter. You can unmute and just share your ad, share what you think. Nobody? Oh, 480. All right. 6-4. Delapi, you give me 2 answers. All right. The second one was closer than the first one. And I'm going to go with that. And your answer is going to represent everybody because nobody said anything. So I'm going to say that you're all wrong. This is actually 2.56 million. Let me say that out loud. 2.56 million. You see, when we don't take ownership of our money, somebody's still making money with our money. And that's the money that you work for. You see why I say that it's really important to understand the rules, because what you don't know could cost you a lot of money. Let's keep that as a theme. Please write that down. What you don't know can cost you a lot of money. Matter of fact, what you don't know will cost your children a lot of money. Because imagine them learning this about 30 years later saying, I wonder why my mom and dad never learned this and taught me. How did I not get taught this? Guys, money over time does really amazing things with an interest rate. And by the way, the rule of 72 will double in every direction. If you are in the black, it will raise your money and you will be building assets and you'll be building wealth. If you are in the red, and this we're dealing with minus money, it will take you so far into the red, you will not even remember what a zero looks like. Like a clear balance, you will not remember what a clear balance looks like. Because think about it, 12% is doubling every 6 years. The average credit card is over 25%, which means that's doubling in less than 3 years. You get a credit card that's at 40%, it's doubling in a year and a half. 1.5 years. Now, I can labor this, but I'm not going to. I'm going to keep going because we do have other sections. So the rate of the return, and I want you to think interest rate is what you get charged, but rate of return is what you receive. Different concepts, but rate of return is the same principle. If you put away £1,000 at the time that your kids are born, now Delapo, I think we're really close to that time. You put away £1,000 and you don't put any more in there, but you were to get 3%, I'll show you what happens. What happens at 6, what happens at 9. And the money just sits there until retirement. Now, this is an interesting concept that I learned about 15 years ago. I want you to think about this. That £1,000 will, over those years, turn into £406,000. So think about this. You put in £1,000 investment at their birth, and then you leave it. Let it just keep growing. By the time they're ready to retire, they would have had their jobs, they would have bought their house, they would have raised their kids. They would then have 406,000 that was just sitting there growing, waiting for them. Now, they might not even use it. They can have money that they can set up for their grandkids or their great grandkids. Now you basically made sure that your kids have no retirement worries, because on top of everything they have done, there is this pot. But if it was at 6%, it'd be 55,000. Now look at that huge jump. 9%, 6%. If it was at 3%, that same 1,000 just sitting there, be 7,400. This is the difference in rate return, and this is with your money growing. So we're going to talk about some other examples, and I'm going to show you how this works in the opposite direction against you. But this is what it just is a simple analogy. £1,000. It's not like you're adding to it every month. If you were able to add to it every month, these numbers would be higher, but you haven't done anything. That 1,000 is sitting there just accruing interest over 67 years. Okay. So where we at? This idea of becoming an owner, not a loaner, is about how to bypass the middleman. See, your money, instead of taking your money and putting it directly into the bank and letting the bank move it on, you bypass them, put it where they were going to put it, so that when the returns come, you get the same returns that they were going to get, but it's your money. Now, of course, you're going to assume more risk. But remember the first one we went through? In a savings account, you're earning a guaranteed loss. Your money is losing value regardless. Now, I'm not going to say just go out and invest your money. Get advice. You know, if you do have an interest in this, let's have a conversation, because we do have an investment company that we work with, and they will take you through a risk profile, help you work out where you're at, what's perhaps the best strategy for you, and they will talk to you about things like that and help you manage the portfolio. Don't go into this blind, but similarly, doing nothing is equally as bad. So I've come to the end of this section, so let me cover some of these mistakes that people have. And by the way, that QR code can put you straight into my diary if you have a desire to find out some more about what we do. Matter of fact, let me give me a second. Let me put it into the chat so that you guys can, if you can't do the QR code, at least you will be able to sort of pick up on the chat. So give me a second. Let me grab that. There we go. Okay, so you either use a QR code or use what's in the chat there. The common errors that people make, particularly with dealing with their money and this whole idea of becoming an owner, not a loaner, is not having a plan. Guys, we plan everything. Hopefully you make a plan when you're going to the supermarket. I know you definitely make a plan when you're going on holiday. If you're about to drive to London, you get into Google Maps and you make a plan. You make a plan. Now, if we're talking about our money, why are we not planning with our money? Why are we not making our plan for our financial lives? This is a really big mistake people have. They kind of wing it. Don't wing it with money. The mistakes you make with money can last for a generation. A mark on your credit history is 6 years. 6. and this is the worst thing about mistakes you make with money is that they're generational, because you learned about money by watching your parents. So guess where your kids learn about money? By watching you. Now, chances are they're going to copy the wrong things you do easier than the right things you do. Not making a plan teaches them it's okay not to make a plan. And it's not okay to make a plan. Make a plan and start today. Don't put these type of things off. Putting these things off just delays it. And remember, time is a very important factor when you're dealing with money. Ignoring the effect of inflation on savings is a major thing. Not knowing what the interest rates are. Guys, when I get together with people and they say, I have a credit card, and I say, how much is the interest? And they say, I don't know. Tells me that this is a 6-year-old handling money, but it's real money. And listen, please take this in a way it's intended. We are all at one point, we were all at one point 6-year-olds handling money. Because chances are nobody sat you down at the dinner table growing up saying, this is how money works. The wealthy families, that's what they talk about over dinner. How money works, how to grow your stocks. We have a guy who works with us in our company, and he was giving his son's pocket money. And Delapa, you love this. When the boys were old enough, he said, look, I can give you this pocket money, but I am investing in property. If you want, you can give me back the pocket money and I will give you a share of this property. So now your pocket money goes towards investing in this property. From the time before they were 12, the two eldest ones, they were like, yes, Dad, take the pocket money, put it in the property. The 6-year-old wanted to keep his money. And then when he saw his brothers getting return on the property, he was like, you know what, Dad, take my pocket money. These kids are in university and they own their own property already. I want that to sink in. They own their own property in university, but they've been having these conversations since primary school. When we don't know as adults, what chance do they have? Not knowing the rule of 72 is a big one. So I would say these are common mistakes when it comes to this first bit here about money. So I hope all of that made sense, and I hope you guys took notes. Take a deep breath. We're going into the next one. So how to pay off debt faster. Remember the things we talked about in the first section, because it's going to come in useful right here. Because it's about how money is growing, right? And this is the thing with debt, the rule of 72 is working against you. So I want you to understand that firstly, there's two different things about that. There's a revolving and there's fixed. When it's revolving, it means, well, actually, let me just ask. Anybody know the difference between revolving and fixed debt? You can just put you don't have to give me a full answer, yes or no in the chat, is fine. Revolving and fixed. When I explain it, you'll understand it perfectly. Because I don't think we really think about it. So TJ, no, that's fine. Fix is also known as amortizing, because the debt will die, right? So revolving and fixed. Revolving is like your credit card. Interest is charged every month. Fixed is a loan, a mortgage, because the interest is put in at the very beginning. So if you had a debt of 17,000 at 18% and it's revolving and you're paying $595 a month, that debt is going to take you 17 years and 2 months to pay off. The same 17,000 at 18% and $595, but fixed, where the interest is added into the beginning calculation, is going to take you 3 years and 2 months to pay off. You will pay $5,730 on top of it. Can you see the difference there? They look the same over here, but these are your credit cards. These are your store cards. This is your loan, maybe your car finance payment, your mortgage. You're paying a lot less, even if they look the same at the beginning. So I'm going to, remember, I don't give advice. I'm going to give education. In your non-expert opinion, which one of those would be better for your family? Revolving or fixed? How many of you think revolving? Put an A in the chat if it's revolving, a B if you think it's fixed. Which what fixed? So I see TJ said fixed. Yep. Bukola, A, you think revolving is better for your family, or did you get the letters mixed up? Because I want to make sure.
Mixed up. Sorry.
You got to. Okay, good. because we needed to have a further conversation otherwise. Right. So this is something that's very important to understand, because we don't realize, okay, they're very different mechanisms that are happening here. That might look the same, working differently. So let me go on, because I want to cover debt stacking. Now, debt stacking is great because you can use debt stacking to get rid of your debt without adding any extra money. Now, if you add more money on top of it, you will supercharge what I'm about to show you. But this example has zero extra money. So all the money you're spending is all the money you're spending. You're not saying I'm going to spend more money. You're spending the same money. Now, as we take a look at what's here, we have a retail card, a credit card, a loan, a credit card, and a mortgage. So we know that's revolving, that's revolving, that's revolving. And the car loan and the mortgage are two fixed debts. And in total, the amount going towards the debts every month is $2,720. So as we go, this card at the 220 is probably going to finish first. When it finishes, most people will take this 220 and they say, I now have more money. I can afford this extra thing, right? Because that's what most people do. They will take the 220 and go get more debt. Am I right? Or am I right? Right? That money is going into the pocket, and they're going to buy something that they were waiting to buy because now this money is freed up so they can get it. I want to suggest to you that if the goal is getting out of debt, that's not the option. That 220 should then be added to the credit card payment here. So you're going to take that 220 and then you're going to add it to this 353, so that now on this credit card, you're paying 573 instead of 353. Is that making sense? So now this credit card has got an additional payment from the retail card that just got finished. You're still paying 2720. And then what will happen is this will finish faster now. And you take that 573 and you drop it down onto the car loan, which was 551. So now in a car loan, you're paying 1124. So now you're really starting to pay off this car loan, still paying the same 2720. You have not paid any extra. You do that again with the second credit card of 303. That card now paying 1427. You're turbocharging through that card. And then at the end, you start putting all of that onto the mortgage. You're still paying the same 2720. You have not added any additional funds. So a lot of people like, I don't have enough money. Well, listen, follow this step-by-step process and you start to create a snowball avalanche effect to get rid of this faster. But what does this mean? Let me show you what this would do, how this would translate. Now, again, for your specific situation, it'll be different, but book a financial plan and we can talk about where you are and how to get to where you want to be. Without the debt stacking, you don't save any interest. You're going to pay $214,000 in interest, still make the same $2720 every month, but it's going to take you 23 years. With the debt stacking example I just showed you, this is finishing, that debt finishes in 9 years, not 23. 9. That's 14 years early. I like to help people think this. How old would your kids be when it finishes in the stacking option? Because I once did that with a lady and I said, by the way, if you follow this, you would have paid off your mortgage and have zero debt before any of your children went to university. The youngest would still be in secondary school, but there would not be a mortgage and there would not be any debt. What would life look like then? You know what she told me? Faye, she told me I ruined shopping for her because she went shopping the next time she was about to buy something and she thought, oh my goodness, I can pay off the mortgage faster. And then she didn't buy it. So she was vexed with me, but she was happy at the same time. I was okay with that. I was like, I'm happy to ruin shopping for you. If it means that you get to own the house outright, bring it on. In this example here, with the debt stacking, 130,000 pounds of interest was avoided. Let me explain what that means. That means the bank made 130,000 less from your debt than they thought they were going to. How many of you are okay with that? Or are you thinking, oh no, those bankers, they need that extra 130,000. I should keep that debt because otherwise they won't be able to have that second car or second home. I once spoke to a guy and he was like, he was selling a house. The guy bought the house from, he said, I wanted to buy a yacht, so I'm selling this one. He already had 3 other places. He was selling a house to buy a yacht. I couldn't comprehend that consideration at that point in time, but I understand where these people are going. If you think that your family would rather have the 130,000, you know what to do. If you think their family should have the 130,000, you know what to do. So compare here. In the first example, you're going to pay 214,000 pounds of interest, but in this one, you pay 83,000. Same 2720 every month. Now, if you want to pay less interest than this, you might want to add a little bit of money to this process, but you can see how it's working. Is this making sense? So we're just following through on this principle. Debt stacking is easy to do. It just requires willpower, discipline. And I would say, have a conversation with the entire family and bring everybody on board, and it becomes a lot easier. Because when you have no debt, I mean, hey, listen, all of us know that debts can be like this massive weight. It's like walking around with a heavy rucksack, stones in your pocket, and really heavy shoes, right? While you're drenched and soaking wet. It can be debilitating. All right, let me keep going. So common mistakes here, again, and I'm going to keep saying this, get a plan. The financial plan is for free. If you're interested, book in. If you, yeah, go for it. Now, common mistakes here, not valuing your credit. Understand what this means. Credit is how people measure your ability to handle debt. I don't have a particular problem with credit cards. I would say I like to eat cooked food, which means that I don't have a problem with fire either, or knives. I have no problem with knives. I like to cut things up, but I will use a knife with a lot of rules, and I will use fire with a lot of guidelines. Same thing with a credit card. I'm not going to say get rid of all your credit cards. I'm going to say learn the rules, or put that thing in a cupboard and don't use it. Right? Because it is like, you know, if you wanted to cook your food, you don't light a fire in the middle of your living room. You know, you take, if it's a fire, you take it outside, or you put it in the stove, or you do something and have it in a way that it's not going to burn down your whole house. It's the same thing with a credit card. It can destroy your life, or it can add value, but you have to understand the rules. Now, raising credit card limits can be a risky thing, because a lot of times people do this because they're looking for additional money to basically just get further into debt. The key about a credit card is to not really need it or rely on it as much as that. Use it to pay for stuff and then clear it. There are a lot more consumer protections with a credit card. If you're using a credit card and somebody steals the money, it's not your money. You're safe. If somebody steals your money on a debit card, it takes a lot more time to get your money back, and you only covered up to a certain limit. But at the same time, you got to be able to clear the credit card. So using a credit card to spend money that you already have makes a lot more sense than using a credit card to spend money that you don't have. Is that making sense? All right. Not monitoring your credit history, not monitoring your credit score, not knowing about interest rate and fees. It's a lot of not knowing. These are the mistakes that we make here. So there's a lot of things to keep your eye on. But guys, when you learn to drive, I mean, how many of you, when you remember when you were learning to drive, it was like, I have to be looking everywhere at the same time. I mean, left mirror, right mirror, in the wing mirror, who's behind me? What is there kids coming out in front of me? I felt like my head just had to be on a swivel all the time. Right now I can do it and I can see it, but it's the same thing when it comes to dealing with money. There's a lot to look at, but it's not impossible. You got to practice it, you got to learn it, and get somebody to walk through certain areas with you, and make sure you're doing this with a plan. Okay? All right, deep breath. Mortgage is not a home. I personally like this one because I know that we celebrate getting a mortgage, right? A mortgage is a big thing. I've been to churches and we go in there, and you know, when we have the praise report is, praise the Lord, I got a mortgage. Qualified for mortgage. I remember when I got my first mortgage, it was the same thing. It was like, we got it. But I want you to think about what that is. All right. First of all, a mortgage is not an asset. Somewhere along the line, the mortgage became synonymous with home. It's not the same thing. That, I believe, was a bad branding exercise. Well, not bad, a misleading branding exercise. A mortgage is not a home. Mortgage is a financial product. If you have a mortgage, you basically have a certificate that says HSBC owns this location and you get to live in it, provided you pay them every month. for a certain number of years. Does that make sense? Or maybe Halifax. Halifax owned his house. So next time you guys invite somebody home, open the door and say, hey, welcome to Halifax's house. Welcome to the, I don't know, whoever your mortgage provider. Welcome to Santander's 37,000 home, because it's not yours. If you stop paying for it, they're coming to get it. It's a financial product. The bank owns the property until you pay everything on that receipt. It's not yours yet. Okay, you're buying it from them slowly. They bought it for you in advance and you get to pay them back. And if you stop paying, they're not giving you back the money you've paid so far. They're just keeping the rest of the house. Okay? So once we understand a mortgage is not a home, this is a very important concept. The next thing is to understand the word mortgage actually comes from Old English and French. It means death pledge. How do you think about it? Mortgage. It's a death pledge. You've entered into a death pledge. This loan dies when it is repaid or the borrower defaults. This is not the celebration. I mean, hey, celebrate, but do it in context. Understand, yes, I am one step closer to owning a home. I don't yet. I'm now paying rent to the bank. I don't quite own it. I'm now into a death pledge, but I'm one step closer to owning it outright because you are not done yet. That's the main thing. You're not done yet. Now, there are ways that you can finish faster. We do believe if you want to really gain value for your money, you got to accelerate your mortgage. And one of the things that we will cover, and I won't go through it right now here specific, but we can do that when we look at, if we get together and look at this with you guys, particularly and sort of individually, is how one of the acceleration techniques that we teach, and that is about your frequency of repayment. Okay, so let's have this here. We got a loan of 225,000. It's going to take 25 years. The total cost is going to be 356. The interest is going to be 131. Okay, so that's kind of a typical type of property. What's the interest rate on that? So an interest rate of 3.99%. Now, that's assuming that we pay our mortgage monthly. Why do we do that? Why do we make a monthly payment on a mortgage? Because the bank says so. Now, keep in mind, the bank doesn't say you have to pay monthly. Have a look at your own paperwork. I believe it will say you must pay, you have agreed to pay X amount by a certain date. Not once a month, but a certain amount by a certain date. Because you realize if you were to go and make a fortnightly repayment, so this is a concept called finding the extra month. If you make a fortnightly payment, now that's not for, if your mortgage is £800 a month, that's not about making £800 every 2 weeks. That's £400 every 2 weeks. Now, I didn't say twice a month, I said every 2 weeks, every fortnight. So every 14 days. Now, I want to keep this a little bit short, but there are 12 months in a year and 52 weeks. If you go every 14 days, that's 28 cycles. Is it 28? No, sorry, 26. So if you pay half 26 times, you've paid the full amount 13 times. All right? So you've now made 13 whole payments instead of 12. Are you guys still with me? You tend to cut 3 to 4 years off of your mortgage by doing that. You would end up saving money. In this example here, you would save just under £19,000. How does that work? Well, remember, your mortgage has interest. Every month, every day is calculating the interest. And if you pay once a month, you've allowed the interest to build up for 30 days before you pay. If you pay once a fortnight, you're attacking the capital a lot more frequently, and you're reducing the amount that the interest can be charged on because the capital starts to fall faster. We can talk more about this in a one-on-one scenario, but understand that there is more that you can know even about paying back your mortgage. There is so many rules that we just have not been taught. If anything's being impressed on you, I hope that's it. There is so much more that we can learn. Now, for those of us who are not yet on the mortgage ladder, you still want to get there, I want to teach you a formula called ICE. This is what a lender will typically be looking for. So if you're making notes, write ICE down, ICE. I stands for income. They're going to be looking at your income, and depending on the lender, it's ×4, ×5. They're going to work it out, and there's a traffic light system that most of them use to just see, is it affordable? Your income must be enough to afford that property, and they will be judging that. Credit history. Have you been applying for credit? Have you been paying things on time? Do you have defaults? Do you have missed payments in your name? We were told one story of a guy who was struggling to get a mortgage because he got a mobile phone in his daughter's name and she missed the bill. So it went up on him. It looked like he missed the bill on this mobile phone. They look at this. You want at least 12 months clean history, ideally more than 12 months. If you have issues within the last 12 months, you will have less lenders that are available, and they're likely to charge a higher interest rate. Okay. Then you have equity. Equity is the deposit. The amount you have to put down will greatly influence this. Now, when we're looking at ICE, you want 2 out of the 3, at least 2 out of the 3 to be great. One of them could be so-so, but if you have more than one that's kind of, you're going to struggle to find a lender, and the interest rate is going to be higher. But this is kind of what you're looking at. And if you're thinking we want to get there in a couple of years, start plotting this right now. Right? Start looking at this right now. Make a plan. We're always coming back to a plan. Now, I always want to talk to people about protecting themselves. And this is a big part of financial planning, because if you don't have a risk management element to it, you haven't created a plan. Right? If you don't have what do we do if this happens, you don't have a plan, right? The plan must have in case of emergency, this is what we will do. But when it comes to protecting your money, you got to protect all of your money, not just the mortgage. So just giving you an idea where a typical household budget goes, Brits spend the most on transportation, housing, and food. 13% of our household budget is transportation, 36 towards rent, 55 on mortgage, and 12% to feed ourselves. So you realize where we live isn't everything. There's a fair bit that goes elsewhere. Let me give you a bit of a graphic here, right? Average household bills every month. So about half goes on housing, but the other half, electricity, water, council tax, food, it's not really stuff we can live without. I mean, if you have the house, but you don't have the rest, what are you going to do? Actually, I want to make that actual question. If the house is sorted, but you don't have money for the rest, what do you do? Answers in the chat. Thoughts? Because you can't borrow from anybody. They'll say you have a big asset. You got a whole house there. Oh yeah, but I don't have money for food. I can't pay the council tax. Yeah, that doesn't make any sense. You have a whole house. I'll tell you what it is. You probably end up having to sell the house. So at the end of it, you won't have a house. I met many people who have an insurance to protect the house, but nothing to make sure that their survivors have enough for food or council tax or even heating, or can continue in the education, paying for the schools that the kids are going to right now. But they'll have the house. But what about the rest? You see, when it comes to protecting your family, there is more than just the house. As a matter of fact, I want to use this here as the, well, I'm going to come to it, right? Most families cannot survive on half the regular income. And I'm not even going to ask you that question. I'm going to tell you that as a fact, because I've been doing this for 15 years. Most families cannot survive on half of their income. There used to be a point where everybody can survive on a single income, but that's not today anymore. That was long in the past. Now we kind of rely on both incomes. If you remove one, as drastically as happens with a death or an illness or injury is in a way kind of worse, because now the surviving member who is still working has kind of a responsibility to look after the one who's ill and can't work. So now they have a stress to look after the partner that can't work while making money. It's kind of harsh to say, but that is kind of worse than if the person died, because there's a grief process, but your time is still able to be used moving forward. And it's a hard thing to say, but it is a reality. Death or the inability to work, will the family remain financially stable? If the mortgage is paid and that's all that's happened, chances are still no, because there's a lot of extra monthly bills that are going on. So what we encourage people to do is think about it like this. This is called the theory of decreasing responsibility. Because when it comes to this question of wealth and money, there's really two things that I think we ought to be doing. The first one is building, and the second one is renting. I want you to think of insurance as renting money. That's basically what it is. You're paying about so much every month and say, if something happens to me, pay me this much, pay my family this much. I'm gonna give you this much every month. You're gonna give me back this much if something happens. Where else can you transfer 50 pounds a month to be equal to 550,000 pounds in total? Right? It's not an equitable transfer for the person who's paying out. You're always going to be paying way less. So you're renting wealth. Now, you don't want to rent forever. You want to rent while you build. Now, remember, the first couple ones that I talked about was about how to grow your money, how to get rid of your debts and grow your money, right? If you are building your wealth, there's going to come a point where you don't need to rent it anymore. Now, let's use the renting and building analogy. Let's say you're renting your house while you build your house, okay? When you finish building your house, you're going to stop renting. Am I right? You're going to stop renting. You're going to say to the landlord, I no longer need to rent. What you're not going to do is you're not going to say to the landlord, okay, so now I've built my own house. Can you give me back the rent money? Because he watch you like you're crazy. So you've lived in my house for the past 10 years and now you want back the money. Well, give me back a new house, right? We wouldn't do that. I don't understand why people, when they get insurance, they're renting the money and they think, oh, well, where can I get the money back? It's not an investment. You're renting money for an emergency. Okay. So this is where we are renting. And why? Because if anything happens here, could be kids, debt, mortgage, all of these things would be in jeopardy. So we're renting enough to cover all of our responsibilities. Now, the great thing is that as we move on, the responsibilities decrease, right? So we got decreasing responsibilities. So the kids are grown up and then they look after themselves and the debt's reduced and the mortgage is paid off. So what we really need is the wealth that we've built, right? So that's where the first few sections about, become an owner, not a loaner, and understanding the rule of 72 and understanding how your money grows, that section comes into play because when you get to retirement, you don't want to just have 40,000 pounds. You want to be able to have retirement money. As in, oh man, it's cold. Let's go to a country that's warmer for the next 2-3 months, right? That you want to have that kind of money while you're still paying for your council tax and stuff in the UK, but you're not here anymore because you go somewhere where there's sunshine and you can eat fruit that actually tastes like fruit, right? That's what you want to do. That's retirement money. Not, I can't turn the heating on because I have to pay the rent, right? That's not retirement money. So you're building, and we start building as early as possible so that in the later years, we have the money and we don't have to rent it anymore. Is this making sense?
Yeah.
Now there's, and I didn't put the slide in here, but we can talk about the different types of cover because you have cover in the event of death, you have cover in the event of illness, you got cover if you can't work. There are different things, and it depends on your situation, what you get. You just rent in the right area to make sure you protected your family from whatever is needed there. And guys, I could give you loads of examples, but chances are, if you think about your community, because the church is a cross section of people, you will see that what I'm explaining here has happened to some people that you already know. I can almost guarantee that is a fact. Some people would have benefited from knowing this information years ago. One story, and I'm watching the time, but one story here. I had a client who was traveling last year and her policy lapsed. It canceled because she wasn't paying for it. So I then spent the next 8 months trying to reach out to her, so to say, hey, can I help you get this sorted? Can I help you get this sorted? In January, this policy got sorted. Do you know, it's only a few months later that she had a serious illness and is looking to make a claim on it. I was like, I am so glad I chased to to get that sorted so that there was cover in place. See, we never know when something's going to happen. We don't, but we do know that when it does, it's not, it would be great if we could say, listen, I'm ill. Can we just suspend my rent or suspend my mortgage? Can you not charge me for the electricity and the heating? Because I really can't work. I'm really sick. I have had a stroke. I can't do anything. Can you just stop charging me? It would be really good if they said yes. But they're not going to say yes.
Yeah. Exactly.
Oh, we're really sorry to hear that, but we really need to get this account sorted. We're really sorry to hear that, but we really need, and it's just not going to be manageable. This is why we rent the wealth while we build it. Okay. I'm not going to labor that one too much. Have a follow-up with me if we want to have more conversation. Common mistakes: not seeing the mortgage as a liability, not making use of overpayments. They put it in the paperwork to say you're allowed to overpay. Most people don't make use of the overpayment. They don't act early when they're remortgaging. You will get a notice for your bank up to 6 months before your remortgage date, and you can act up to 6 months before you get a remortgage date. And guys, the earlier you act, the better interest rates you will get. If your date is in like 2-3 weeks, you will not get a good interest rate, and you will have to take what you get because you have to have something. So act as early as possible. You can act to 6 months. Getting professional advice when you're doing this. Now, by professional advice, I don't mean going to the bank. And when you go to the bank, they will give you their mortgages. Barclays will give you Barclays mortgages. Halifax will give you Halifax mortgages. They're not going to tell you about the other people that are offering it. There are over 200 mortgage providers in the UK. That's where you get to them through a mortgage broker. Yes, it's a professional. Yes, you're going to pay them a fee, but they are going to get you access to everybody and find the one that's best suited to you. Most people don't want to do that because they want to save a little bit from the brokerage fee and lose it on the deal that they get. It's the phrase is saving at your own expense. It's not, saving isn't always save you money. Knowing your interest rates and fees. Again, got to understand what this thing is costing you. All right. I'm almost there. Dapo, how am I doing? Dolapo, how am I doing?
Great. We still got some time left.
Okay. Not using wills, trusts, and LPAs. I'm not going to say anything else on that. It's very important. 7 out of 10 families don't have a will, and 4 out of 5 people in the UK, 4 out of 5 adults in the UK do not have a lasting power of attorney in place. Those are big deals. I'm not going to say any more right now because I will run out of time if I do. Okay, how to take control. So quite simple. Your situation, and I'm going to use my family here. Let's call them Bob and Sandra, right? Bob and Sandra and the kids, like everybody else, they do not like to be sold a product, but we do want to buy. And more than that, we actually have a need for financial services, but nobody likes to be sold. We don't like the idea of a salesman or them selling tactics or somebody trying to convince us or trick us or push us or cajole us. We don't like that. We do want the product. We need the product. We want to buy it, but we don't like to be sold. So the solution is to build your own financial house and learn the steps. So I'm going to take you through this very quickly. And if we meet again, you will definitely hear me talk about this. Step 1 is risk management. Like I said, all financial planning begins with risk management. If something happens, is there enough cash or is there enough insurance to protect the family? Next one is managing debt. So after you set the foundation, you got to get rid of the debt. And by the way, the debt includes cards, loans, mortgages. Mortgages is in there. All other borrowing. Is there a strategy to get rid of that as quickly as possible? Because remember the rule of 72, the longer you hold this, the more it increases and it's going to start doubling. Then it's about expense management. Basically, this is a budget. Do you have a plan for your money before you get paid? If payday is the first of the month, you should know what's happening to that money before the first of the month. All of it. Give every pound a purpose. Give it a purpose, whether it be saving, whether it be tithing, whether it be money for your kids, money for whatever. Put it to work before you get it. If you don't put it to work before you get to, there's a little thing called advertising. Now you might think, oh no, I don't, advertising doesn't bother me. Well, why do they pay the advertising industry millions? You know why they pay them millions? Because it does work. Trust me, it works. So you have to have a plan first, because they have a plan to get your money. Then about a plan to replace your salary in retirement, have a short-term buffer, have a meet your goals. What's your asset management, your asset growth plan? And I'm going to have a bit of a section where I talk about income management again, because it's an important question. And I want you to think about this. Are you keeping your options open for income and business opportunities? It is said that the average millionaire has 7 streams of income. 7. And in Ecclesiastes, interestingly enough, it talks about dividing your portion into 7 or 8, because you do not know when the day of adversity will arise. I want you to think about that. It's in Ecclesiastes. What does that mean? Have you ever heard somebody who lost their job and then they didn't have any money? So they had one stream of income and then it went from 1 to 0, and now they're struggling, right? And what did they do? They go from 0 to 1. I would have thought, well, you should go back to at least 2, because if you then lose 1, you're still on 1, right? And if you have 2, then why not get 3? Get a third one, get another stream coming in, because you don't know where the challenge is coming or when the challenge is coming. Nobody knew that the world was going to shut down in 2020. Nobody knew. Nobody knew that office manager would be a defunct role, going the way of typist. It just doesn't happen. The whole role disappeared. Oh, we don't have an office. We don't need an office manager, right? So have an additional stream of income. Take that personally. I will make sure that my family has more than one stream of income. That's your mission. Now, go on. So the financial plan addresses all of these. And the financial plan looks like this document down here. So it talks about debt elimination, ensuring your family is properly protected, budget planning, planning for key life moments, planning for retirement. It's a usable document because it says, this is where I am. This is where I want to get to. This is what's going to happen if I add a little bit extra to my debts. This is what's going to happen if I use the debt stacking. This is what's going to happen if I use fortnightly repayment on my mortgage. That's what the financial plan is going to give you. It's going to give you a bit of an oversight. Now you're going to have to update it because our financial lives are very dynamic and fluid, but it's a great marker to see this is where I am. This is the direction I need to go to. Okay. Pay yourself first. This is a very important principle. Typically what happens when we get paid, we make sure we pay our rent. We then pay our electricity, we pay our car bills, and then at the end of it, we see what we have left for ourselves. I want to tell you that every wealthy person I know, and these people have over 7 figures, right? Every millionaire I've ever met does not do that. They pay themselves first. What do I mean? First 10% goes towards, we're going to break it down in 10, 10, 70, by the way. First 10% is charity or giving. I actually, strangely enough, know a lot of millionaire believers. They tithe. First 10% goes to their church, goes to the tithes, goes to any organizations they support. Well, no, the church and then organizations. They tend to give away more than 10%. Second 10% for us normal people would be short-term savings. This would include things like your emergency fund. Then we have a bit longer term goals, maybe a deposit, maybe kids' education. Then the last 70 is the rest of your life. That's where your rent is. This is where your mortgage is. This is where the grocery shopping is. Guys, if we mix this up and do it the other way around, we'll never find that 30% there for tithe, for charity, for savings. We're never going to find it. That money doesn't exist at the other end. But if you do it this way around, you will find that maybe you buy less in the supermarket. Maybe you're a little bit more discerning about what you purchase for, what you spend your money on. Now, if you genuinely don't have the money, maybe instead of 10, you do 10, 5, 5, 80. Or hey, 5, 5, 5, 85. Work it so that you build it up to doing 10, 10, 10, 70. And then see if you can go and live on 60% or live on 50%. Squeeze the rest of life as small as it can be so that you're paying yourself and paying your family. Savings is nothing more than paying your future self today. You're paying for stuff your kids will need today. That's what savings is. You're paying for that holiday you're going to take in a few years' time. You're paying for it today. You're paying for that flat tire that you're going to replace. You're paying for it today. That broken washing machine, you're paying for it today. That's what savings is. And it's a great discipline. Okay. Now, as a good mental exercise, stop thinking about it as savings. It's just another bill. It's a bill to James Adeyemi. James Adeyemi has just invoiced me for 10% of my income. My goodness, that guy's expensive. He just invoiced me for 20% of my income, and I got to pay him first. He is my priority creditor. That money is going there before the rent or the mortgage, because he's going to come get me. I cannot escape him. He will find me. You know, I can not answer the phone from anybody else, but I cannot not answer the phone from James. You know what I'm saying, James? You can't get away from you. It's why you are a priority creditor to yourself. That's how don't say savings, right? Now, really, I'm going to give you 3 types of savings account. And this is sort of like a more complete program. Now, to be fair, these are headings. The emergency fund is one. This is your 3 to 6 months worth of income. But the short-term savings, that could be about 5 different ones. That could be holiday and Christmas. That could be kids' birthday. You know, these are short-term pots. Anything that's happening within the next 5 years, you can have a variety of different short-term pots. Similarly, you can have a variety of different short-term investments. You have 3 different types, not necessarily 3 accounts, but 3 types. I would love it. You know, we tend to have like 4, 5, 6 credit cards. What if you had 4, 5, 6, 10 investments? Just different ones. This is for that. This is for that. This is this child's education fund. This is this child's education fund. This is for if they wanted to get on the property ladder. Have a variety of different savings and investing accounts. Now, additional income. So now I'm on my last leg here. I'm going to be done at the end of this. This one is a big one because, again, if we don't, we're basically at the mercy of the person who's paying us right now. And a job is, you don't own your job. You have your job for as long as your employer is willing to give it to you. You know, one of my clients called me up and said, do you know anybody that has can offer legal advice? I said, give me an idea what kind of question we're looking at. What's the angle? Oh, my employers decided to terminate everybody's contract early, so I'm going to be out of work in January. Now, they've given us good notice, but I didn't think I was going to need to be looking for a job in January. Now, does that shock anybody? Does that sound like, oh, wow, I've never heard of an employer just giving somebody notice and saying, we're not going to need you after this point? No, it seems kind of normal. If that's a normal type of thing that could happen because you don't own the job, why do you only have one source of income? It's kind of gambling. You know, there used to be a time when we'd work one job for 40 years. I've never lived in that time. I've never lived in that time. I know my grandfather he worked on the docks. He worked on the docks for decades. He retired and they, you know, big party. Everybody knew who he was. He was there for decades. I think the average turnaround time in a job right now is somewhere between 3 to 5 years, if that long. We don't have job for life anymore. You know, as a matter of fact, the typical theory of this is sort of like the 3-stool thing, right? So this is how it used to be. When you come to retirement and it's time to sit on your stool, you would have the Social Security. So your national insurance is going to pop in there and they're going to provide some stuff. The personal savings that you had is going to provide some stuff. And then the pension is going to provide some stuff. This was the theory of how you would retire. Well, pension isn't that much. Most people don't have personal savings because savings haven't been growing. So personal savings, when it's like at less than 1%, it's not really going to be a leg on the stool that you can balance on. And we know we can see with our own eyes what's happening to the NHS and the idea that we can rely on sort of our national insurance contributions to look after us in our old age. Well, at this stage, unfortunately, that's a fiction. These legs will not support anymore. Simply put, if we want to have a good retirement, it's on you. It's up to you to do something today with the knowledge that you have been given, with the opportunities that you've been given, and the strength that you've been given. All right. Now, hey, I know I'm speaking to a church, and I don't believe that it's always going to be all up to you, because I do believe that we serve a God with a plan. But I also think that is why I am here today. Okay. I don't think I'm here by an accident. I'm here to tell you something that you probably should know and probably should act on. That's what it is. It's to give you more information so that you could know better and do better. Now, most people are not making enough money. It's not that they have too much debt, it's that they're not making enough money. If you think about it, everything that we buy today has gotten more expensive in the last 5 years. But just over that period of time, we have watched our shopping basket not increase in quantity, but increase in cost. We have watched the petrol going into our tank increase in cost. I remember when I learned to drive. When I learned to drive in 1997, petrol cost, I'm giving my age out here. Petrol costs 53p a liter. I just saying that makes me feel old. Petrol costs, I remember when petrol crossed £1. When petrol crossed, if you guys remember, petrol crossed £1 a liter, and the truck drivers went on strike, and they parked along the motorway, and they shut down the motorways because they were like, it's too expensive. Petrol crossed 160 over this last recent time. It's crazy. Everything costs more. So it's not that we have debt problems. Majority of people have an income problem. They've done loads of studies about it. We are still earning at the rate of 2008. If our income had grown with the rate that money had grown, we would all be, every family in the UK would be, I think the number is £14,000 better off per year. 14000, £14,000 better off per year, every family. Our income is stuck in 2008. The prices of everything is in 2024. So we're lagging. Multiple streams of income should definitely be a priority for every family. Now, how you do that, I don't, there are different things. Use the skills that God gave you. I will tell you that what we do here, if you're willing to learn, I'm willing to teach you, and I can add this, we can add this as a stream of income. But Ecclesiastes says 7 to 8, right? I think, you know what, let me look it up. I'll tell you what the verse is. And by the way, this is my last slide. So let me say thank you very much for listening. You guys have been very engaging. I appreciated it. I love speaking with you. And I will find that verse, and I'll put the verse reference in the chat for you guys. But if there's any questions, I'm happy to take them.
Yeah, the verse reference is Ecclesiastes 11:2.
11:2. There you go. There you go. You looked it up. Good man.
Yes, I did.
All right. Let me hand it back to you, Delapo, however you want to handle this bit here.
Yes. Thank you very much again, Kwesi. We appreciate your time and your coaching. And would anyone have any questions? Or Sister Tuno, would you like to take over for the Q&A, please?
Question time, everybody. Any questions, please? You can unmute and ask the question.
No, I'm happy. I think Kwesi just sort of summed everything up. He gave answers to perhaps questions that were going to be answered anyway, that wanted to be answered. So I'm happy with that. Thank you, Kwesi.
You're very welcome.
I guess I've got a question. What would you consider a very good interest rate for credit cards, for example, and also good interest rate for mortgage? I know mortgage can vary because you could be new in the mortgage market or existing mortgage owner or something.
Okay, so First of all, it's not about the interest rate with the credit card, because the interest rate is telling you how long it's going to take the credit card to double. So if you are spending money that let's say you have in your debit account £1,000, and you need to make a purchase for 500, and you buy that, you use your credit card to pay that £500. But before the statement comes, you pay off the credit card. So when the statement comes, your balance is zero. Doesn't matter what the interest rate is.
No.
No. So it can be, the interest rate is very important to understand if you are running a balance on the card. If you're not running a balance on the card and you're going to keep clearing that card, the interest rate doesn't matter. The interest rate is going to matter when there's a balance on there and then it applies interest. If your balance is always zero, listen, your card could be 60%. Does it even matter? They'll never get any of your money.
Sure, thank you. One question, because my wife told me this as well, because when I first got married, I had a credit card debit of £2,000 and I kept paying £200 every month, but it never went down. So that was what she said as well, to keep paying the balance off. But for example, can you take some money out of the credit card as good debt for something for your day-to-day bills, like paying off your electricity, your fuel money, and then repay it back every month without help, as far you pay off the balance before the due date, right? Is that what you're saying?
That's what I'm saying. So now understand this, the government has put a lot of protections into credit cards. You have more protection on your credit card than you do on your debit card. So your debit card, you're protected up to a certain limit of money.
All right.
You know, if somebody gets your credit card details and starts spending money, you phone the bank and you are largely covered for that money. That's their issue to deal with.
Yeah.
If they steal your debit card and start spending money, that's your money gone.
Yeah.
It's going to take you a lot longer to get that money back.
Yes.
So the government has put a lot of protections on credit card use. So I would say, even if you had the money and you use a credit card, you're building credit. If you're using a debit card, you're not, you can manage your debit card perfectly. It's not improving your credit. If you manage the credit card and pay it off all the time, you are improving your credit. So you're gaining the benefits there and you're spending your money. So now the key is you are spending your own money. Well, you're spending money you already have. You're using their money, but clearing it off. The challenge is when we use the credit card money and we don't clear it off. Somebody's coming for that money later. You understand this, right? They're coming for that money later. But they're going to wait for it to grow and then just take the interest every time and still leave it there. You become one of their income streams. It's like, I'm telling you about having multiple streams of income. You are somebody's multiple stream of income.
Yeah. Okay. Thank you. And my final question.
I had a question. Sorry.
All right,
go on, Evelyn.
Oh, sorry. Dolope, do you want to finish your question?
No, you can go on. I will ask later.
Right. Okay. My question is, we're talking about building a credit history or being credit history. What's the word? Worthy or some
credit worthiness, right?
Credit worthiness. Thank you. My question is, we've got previously, I've known that people think that if they don't have a credit card, that is good for them because it shows the creditors that they are good, that they don't have any loans or they don't have any credit.
Okay.
But we found out that if you don't have a credit card, your credit history, sometimes you have no credit history. Does that make sense?
Absolutely.
Yeah. Yes.
And you actually have zero history. You do not exist.
Yes, which the part is obviously, as you said, being financially aware what we've just gone through. We've got a young man about to go to university.
Hmm.
And he's quite keen on, well, we're quite keen on him building his credit history. He's
Mhm.
trying to get a phone or something in his name, but
Okay.
currently he's not credit worthy because he's just finished
Oh.
A levels. And
Okay.
my concern was, do we get him try to get him a credit card in his name? However, we will pay, because I remember my parents doing that for my sister. They got the credit card for her in her name, but in a sense, my mom used the credit card as in her shopping and then paid it off to be able to build my sister's
Yeah.
credit history. But I
Okay.
think that it is quite, sorry, it's going round the thing, but I'm asking my question.
I actually love your question. So let me see if I summarize it correctly.
Yes,
Your question is your son, right?
yes,
All right. So your son is about to go to university and you would like to help him build his credit. You remember your mom getting a credit card in your sister's name, her using it, she using it, paying for it, making sure it was paid off. So it built your sister's credit at the
that's
same
correct.
time. So you're wondering, is that a good idea for your son?
Yes. And
Okay.
how do I show him money sense? Like, because if I do that for him, then, you know, where does that leave him? Does that make
All
sense?
right. See, now I love that you added that bit to the end, because first of all, I will not give you advice on that because I'm going to
No.
work more in let me talk to you about how it would work. But my first question was going to be, what have you told him so far about money? Because if he's going to see 16, 17, right?
18.
18, right? So now is the truth test of what you have taught him so far. This is the truth.
Yeah.
Now, I actually heard a guy speak about this recently, and he actually said that he gives all of his, he sat down with his sons before they went to university, and he said to them, I am going to take out a credit card in your name, and I'm going to co-sign it. So I'm going to guarantee it, and I will make sure that it is paid for every month. But I will get the bill, so I will know where you spend the money. I will know what you buy. I will know where you go. But I will pay for it. And at the end of and by the time you graduate, you would have a great credit history because I would have helped you do that. But now it's a bit of an accountability because you got to be we might have conversations about where you're spending money.
Right.
So if you can have that type of conversation with your son, and he is willing to let you know and have conversations with you about where he is spending money, because this is a gift that you're giving him that many of us did not get. I did not get that growing up, right? I don't think my parents understood the concept of helping me build a credit history. That's something I learned in my 40s. So I know that my mom was, as a single mom, she didn't have that ability to do that for my brother and I. But if you can do that, that's a massive gift, and he must understand that that gift comes with a lot of responsibilities. And if he's willing to work with you in that and take some, get to learn how money works, well, I think you would start to buck a trend that I see, because I see young ladies and they have 20, 30,000 and saved, and I see young guys and they have 40, 50,000 of dreams, right? And I want to redress that balance. I want to see young fellas with 20, 30,000 saved, but I'm not seeing that. I'm not seeing that. So if you can do that and help your son get on that side of the tracks and have that level of credit worthiness and financial responsibility before he's 20, that looks like a win to me.
Thanks.
But you're going to have the conversations, because remember, this is a fire you're dealing with. It can burn the whole house down, or it can provide lovely light and warmth and heat, right?
Okay. All right. Thank you.
Okay, no worries. I would suggest actually that you get together with myself or Olatuno and go through, have a financial plan done, and have him do the same thing. Let him see how this process works. It is never really too early to start learning about money. And if you can learn about it before you start earning it, even better. We're already earning money. We should definitely be learning about it. But you got an 18-year-old, he needs to get plugged into something.
Okay.
All right.
Thanks.
No worries.
Any more questions, please?
Any more questions, anybody? Thank you, Evelyn. That was a good question.
Yeah, I like that one.
Yeah.
Thank you.
So everybody, I take it that we understand the presentation and you don't have any questions?
Let
I
me say, just before you go, Delapo, because I did say it was never too early to start learning about money. I want to give you share a story of a client that I had. This lady phoned me up and she said, Quasi, we did it. And I'm not going to lie. I was like, what did we do? They said, we accomplished it. I'm like, okay, you got to tell me, what did we do? What did we do? What are we celebrating? You said, we got the house, we got the mortgage. And I'm like, because I remember when we sat down for their financial plan, they had one goal, get a house. They were in a 2-bedroom place. All 3 kids were in 1 bedroom. And their goal was to get a house where the kids could have their own room. And they accomplished it. And here's what they did. I sat down with mom and dad and we did a plan. After the plan, this is the genius part. Mom and dad sat down with the kids. Now the kids were 8, a twin at 8, and then a 6-year-old. They sat down with the kids and explained the plan to the kids and said, this is what we're doing. And if we do this, we can buy our house in a year. This is why this was genius. Obviously, at some point down the line, the 6-year-old forgot the plan and started with the, Mommy, I want McDonald's. How many of you guys have ever had to deal with that? Dolapo is coming, I think. It's coming. Mommy, I want McDonald's. How many of you have ever given in to that? And it didn't have to be Mommy, I want McDonald's. It could be Mommy, I want something else. Add whatever it is. It's late, you're tired, you're hungry, you just deal with it, get it and move on, right? Before she replied, the son, who was 8, said, no, we can't do that because we're saving money to get the house. Now tell me, did that 8-year-old start his financial education early?
Yeah.
It is good time, right? He ain't got no money to deal with. Nothing that he's doing is going to be with his money for the next 8 to 10 years. But he understood a principle then that was invaluable. And so did this 6-year-old, because she stopped asking for McDonald's. And when I got invited over to their house, we went over and had food with them. Everybody was happy. They wanted to show me their room, show me the backyard, all of that sort of stuff. It was great. My wife and I went over and spent some time with them. They understood a principle of a little bit of how money works. And 6 is not too early. 8 was definitely not too early. Anyway, Dolapo, you had a question.
Yes, quick. It's a quick, tricky question. You asked us to eliminate the middleman, which is the bank.
Yep.
Where do we invest our money then? Is it in ETF or stocks? I don't think I got
I would say what I said was we have a company that we work with which will help you with that. So there's when you engage in an investment broker, one of the first things they're going to do with you is a risk profile. What's your attitude towards money? What's your desire for return? They'll go through a risk profile with you that will give you an idea of how risky you are willing to be. Do it with your wife. You'll find that you have different risk profiles. Then you match up your risk profile with an investment that is fitting. If you like high risk, then there's stuff that will give you a high chance of reward, but there's a chance of failure too. If you want to play it safe, there are different profiles of investment. So I would say you go through an expert, go through that process with them. The company we use has fund managers as well. So you can manage it on your phone via the app, or you can pick up the phone and speak to somebody and get some advice about how to move with your portfolio, stocks and shares, ISAs, their portfolio investing. There's a range there that goes deeper than my knowledge. But I'm the guy who knows the guy effectively, right? I don't have to know exactly how it works, but I can put you in front of somebody who knows exactly how it works. But what I will tell you is trying to get rich at 1.2% rate of return is, listen, Harry Potter is more real than that. That is just never going to work.
Thank you.
Right. That was a simple one. Any more? Are we coming to the end? Are you guys all good?
Well, yeah, I guess. So
all right.
Thank you everyone who has taken time to join the first edition of the Breakthrough Summit presented by DORKAS. That's the DORKAS arm of the church. We hope you've learned a thing or two and would like to make better financial decisions going forward. So, and should you need any one-to-one financial review or questions, please contact Sister Tunu or Kwesi, and they'll be happy to help. And finally, as Kwesi mentioned, I'd like to use the Ecclesiastes 11:2 again to round up by saying, remember to divide your portion to 7 or even to 8, for we do not know what misfortune may occur on earth. So thank you very much again. We appreciate you.
All right. Thanks for having me, guys. Enjoy the rest of your day.
Thank you, Kwesi.
Bye now.
See you, everybody. Bye-bye.
Bye-bye.